Here at the Yield Tree, we don't chase green candles. We dissect the roots of global capital. While the world stares at the scoreboard, we are looking at the Stadium S foundation. Today, the foundation is cracking. What you are witnessing in the silver market isn't a rally. It is a violent, irreversible decoupling. The game has changed. The smart money is quiet. The vaults are empty. Let us look at why the silver dragon has finally woken up and why this time there is no cage strong enough to hold it. If you re-watching this, you've likely noticed the numbers flashing across your screen. $115.28 per ounce in New York, a staggering 11.29% jump in a single day. But to the trained eye, that number is a polite fiction. It is a flickering shadow on the wall of a cave. The real story, the one they aren't whispering on the mainstream news cycles, is happening thousands of miles away in the East. In Shanghai, the silver price hasn't just broken out. It has entered a different dimension. $130.02. That is the reality. A $15.66 premium over the COMEX. In the world of high-stakes macroeconomics, a double-digit percentage premium isn't an anomaly. It's a siren. It tells us that the physical metal is fleeing the West, seeking a home where its value is actually respected. We are witnessing a systemic arbitrage that is draining the very lifeblood of Western bullion banks. The tension in the air is palpable. You can feel it in the frantic updates from the Shanghai Futures Exchange, where they are now imposing emergency restrictions on opening new positions. When a market is healthy, you don't need to chain the doors. You only lock the doors when there's a stampede. The SHFE is adjusting limit up-pay-down ranges for silver, copper, and aluminum, because the velocity of this repricing has exceeded the mechanical capacity of their trading systems. This is the great decoupling I have been warning you about for years. The paper world, built on promises and rehypothecated debt, is finally colliding with the physical world, built on atoms and industrial necessity. It's almost poetic to watch the old guard struggle. Take Jim Cramer, for instance. His recent post on X is perhaps the most bullish signal we've seen in a decade. I am a huge gold bug, but I am not a silver bug, he claims. He calls the rally ridiculous and suggests cashing in on family silver. In our world, the inverse Cramer is a law as reliable as gravity. When the mouthpiece of the establishment tells you to abandon the most undervalued asset on the planet, you know, the squeeze is reaching the boardroom level. They need your physical silver. They are desperate for it. They want you to trade your generational wealth for a handful of depreciating fiat notes so that they can cover the massive gaping holes in their balance sheets. The institutional rot is becoming impossible to hide. Look at TD Bank. Earlier today, they temporarily suspended all sales of silver products. Think about the gravity of that. A major financial institution, a titan of the North American banking system, simply stopped selling. Why? Because they are short. They have been shorting silver for years, betting against the reality of inflation and industrial demand, and now they are staring into the abyss. They aren't stopping sales because of high demand. They are stopping sales because they are functionally insolvent in physical terms. They cannot source the metal at a price that doesn't trigger a total collapse of their margins. This is a bank run, not on currency, but on the collateral that backs the currency. And then we have Goldman Sachs. The news that their head of precious metals trading, Benjamin Benet Lanes, is leaving the bank is the final tell. At these levels of the financial stratosphere, you don't just leave during a historic breakout unless the ship is taking on water. Whether he was forced out for a disastrous short position or he's jumping ship before the regulatory investigations begin, the message is the same. The smartest guys in the room are losing control of the narrative. They spent decades convinced they could suppress the price of silver forever with an infinite supply of digital contracts. They forgot that you can't build a solar panel with a PDF. You can't build a cruise missile with a futures contract. Let us talk about the math, because the math is cold and it doesn't care about your feelings. Gold has soared over $5,000. It is sitting at $5,104.47 as we speak for the first time in history. The $5,000 psychological barrier has been turned from a ceiling into a floor. This isn't gold getting more expensive. This is the dollar losing its utility as a store of value. But the real magic is in the gold to silver ratio. We were told for years that a ratio of 80 to 1 or 90 to 1 was the new normal. Today, that ratio is crashing. It's down to 44.07. Why is 44.07 so significant? Because it's the sound of the rubber band snapping. If we follow the logic of Robert Kiyosaki, who predicts gold at $27,000, and we apply even this compressed 44 to 1 ratio, silver is headed to over $613 per ounce. But even that is conservative. If the ratio returns to its historical pre-fiat average of 15 to 1 or 14 to 1, the ratio that existed when silver was actually recognized as money, we are looking at silver prices approaching $2,000 per ounce. You might think those numbers are astronomical, but they are only astronomical if you believe the dollar is a fixed point in the universe. It isn't. The dollar is a sinking ship, and the price of silver is simply the height of the waves as the ship goes under. The world is finally realizing that silver is the Achilles heel of the modern technological empire. The governments stacking silver for military use don't care about overbought signals on a chart. They care about sovereignty. Every Tomahawk missile contains 15 kilograms of silver. Every fighter jet, every satellite, every advanced guidance system depends on the unique chemical properties of this metal. If you are a general in a high-intensity conflict, you don't check the RSI Relative Strength Index before ordering more munitions. You buy at any price because the alternative is defeat. We are entering a period of global remilitarization where silver is as strategic as oil or uranium. The same applies to the manufacturers. The titans of AI, the architects of the green revolution, the companies building the 5G infrastructure, they all use silver as a small but critical component. If the price of silver triples, it barely moves the needle on the cost of a $2,000 smartphone or a $50,000 electric vehicle. But if they can't get the silver, their entire production line grinds to a halt. They are price-insensitive buyers. They will pay $150, $200, or $500 an ounce because they have no choice. This is the fundamental disconnect that the paper traders in London and New York failed to calculate. They treated silver like a speculative stock, forgetting it is a vital industrial commodity with a finite supply. Look at the velocity of this move. This is the part that should wake you up at night. It took 145 days for silver to move from $20 to $30. It took 10 days to move from $90 to $100. It has taken less than 24 hours to blast from $100 to over $112. This is the definition of a parabolic curve. We are in the vertical phase of the cycle. In a vertical market, there are no dips to buy. There are only gaps higher. Those who sat on the sidelines waiting for a healthy correction at $50 or $80 are now watching the opportunity of a lifetime evaporate. The market is rapidly repricing an asset that has been artificially suppressed for over 40 years. Since the Hunt brothers were neutralized in 1980, the silver market has been a playground for institutional manipulation. But you can't suppress reality forever. You can't print silver. You have to dig it out of the ground. And the ground is giving up less every year. We have seen a decade of structural silver deficits. We have seen the inventories at the COMEX and the LBMA dwindle to multi-decade lows. The short squeeze of a century isn't coming. It is here. I want you to consider the perspective of Peter Schiff, who recently noted that today's gain alone is more than twice the price of silver when he first started buying it for his clients. He is right. This isn't a bubble. A bubble is built on air and hype. This is a repricing. It is the market finally acknowledging that the numerator, the dollar, is infinite and the denominator, silver, is finite. When the world loses faith in the numerator, the value of the denominator explodes. As I sit here looking at the charts, I see silver futures peaking out at $117.43 before settling back to $112.85. The volatility is breathtaking, but don't let the noise distract you from the signal. The signal is that the physical vaults are gasping for air. The premiums in Shanghai tell us where the price is going. New York is just lagging behind, trying to manage a controlled demolition of its own credibility. This is why I always talk about the importance of physical possession. In a world of force majeure clauses and temporary suspensions, a paper contract is just a piece of paper. It represents a claim on an asset that might not exist. But 10 ounces of silver in your hand, that is a constant. That is an insurance policy against the hubris of central bankers. Whether it is the Scottsdale Mint S precision crafted stackers or simple sovereign coins, physical silver is the only way to opt out of the madness. I know what you are thinking. You are thinking, is it too late? You are looking at $112 and remembering when it was $25. But you have to shift your perspective. Don't look at the price in dollars. Look at the state of the world. Look at the debt. Look at the geopolitical fracturing. If silver is the money of gentlemen and gold is the money of kings, then what we are seeing is the return of honest weights and measures. If the system is resetting, then the price is irrelevant. The only thing that matters is how much you have when the music stops. We are watching the end of an era, the era of cheap, suppressed commodities that fueled the illusions of the fiat age. The yield tree is about finding the truth beneath the surface, and the truth is that the silver dragon doesn't care about Wall Street's opinions. It doesn't care about Cramer's tweets or Goldman's trading desks. It is moving according to the laws of scarcity and the desperate needs of a world that has forgotten how to value real things. As we conclude this deep dive, remember that we are in uncharted territory. But the textbooks were written by the people who created this mess. They told you silver was a relic. They told you it was a poor man's gold. They were wrong. Silver is the vital energy of the future and the forgotten currency of the past. It is the bridge between the two. Hold your position. Watch the premiums in the East. Ignore the frantic screams of the experts who missed the boat. The logic of the yield tree is simple. Growth requires deep roots. In a financial storm, your roots are your physical assets. Don't let them blow away in the wind of fiat panic. Watch the yields, or get buried by them. Stay rooted. Stay growing. I'll see you in the next one.